Today, we start topic 8. We are nearing the end, folks. This is the last topic of new information that you'll be given. And as we have in the last couple of topics, in topic 6 and 7, we will be looking at some entries into journals and ledgers that were very simple back at the beginning of the course and now are getting a bit more complicated. So, topic 8 talks about depreciation. The word depreciation means declining in value. And this will be a very important concept as we look at this topic. This video will introduce the concept to you. And if you look on the screen, you'll see a general journal. And I will walk you through some ledger accounts as well as before we begin the actual discussion of the topic. We will be talking about a business called the ACE Delivery Service. And in the general journal, you see that on January 1, 2017, this company bought a delivery truck. And we're going to keep it very simple and say that they bought this delivery truck for cash. $50,000 for the delivery truck. Excuse me. The delivery truck is an asset, and it goes up because it's something of value that we own. So you see a debit of $50,000, and you see cash credited. That means cash, an asset, goes down. It's credited because we spent money, $50,000. So a very simple transaction that we looked at earlier. Way back at the beginning, we had this very same transaction, I think a couple times, dealing with delivery trucks. Now, the point that we'll be talking about deals with the delivery truck itself and the fact that it over time declines in value. It depreciates. And we'll be talking about how the accountant will handle that. Before we get into the specifics, let's look at what else is in this particular assignment. You see a general ledger, and we'll be looking at that. And you see that we have the cash account, an asset, and we're just picking a number out of thin air, really. We start with a debit balance of $175,000, and you see that the entry has been posted, and we need a journal page here. We didn't put that in there, but we should have a journal page there. And you see a cash credit of $50,000. So if this were the end of the year, we would have a debit balance of $125,000 in cash. We have accounts receivable. We're not going to really be talking about that, but a very typical asset account. People owe us money. They owe us $78,000. And over here is our delivery truck. This is an asset account, account 103. And on January 1, we purchased the delivery truck for $50,000. So that's a very simple account. Debit delivery truck for $50,000, as you see, and we credit to cash because it went down $50,000. The thing I want to point out to you here is a new account just below the delivery truck, something called accumulated depreciation. It's abbreviated, accumulated depreciation on the delivery truck. This is something called a contra account, and we'll be talking about that in a few minutes. And we'll be using this account. It's in the assets section, and we'll be explaining what it does and why it's there. So those are the accounts we'll be talking about. There are probably more accounts over here in the ledger, but we're not going to be dealing with them in this particular problem. Liabilities, we'll have a bunch of them probably during the year, but we're not going to be dealing with liabilities in this problem. Owner's equity, we have that account as we've had before, but won't be using that account. Neither will we be using the sales account, the revenue account, but we will be looking at something new in the expense accounts. You see some typical ones there: salary expense, telephone expense, utilities expense, and then something new in the expense accounts here called depreciation expense delivery truck. And this is a new expense account. We keep adding expense accounts. We did that in the last couple of topics. And again, this is a new one that we'll be taking a look at. So these new accounts, we had a new expense account, and we have something called a contra account over here in the asset section, accumulated depreciation for delivery trucks. So we will take a look at what all that means in just a moment. Let's go back now to the general journal and look at that very simple entry we had at the beginning. We bought a delivery truck for $50,000 and we have cash credited for $50,000. Now, this makes perfect sense when we buy the truck. It's brand new on January 1, 2017. But if we would fast forward and look at the account, and delivery truck is an asset, right? Delivery truck has an asset account in the general ledger, and it is debited by $50,000 when we bought it. But if we would fast track a number of years, 2 years, 3 years, even 1 year ahead, the likelihood is that that delivery truck is no longer worth exactly $50,000. And that's what depreciation is about. Depreciation talks about the wear and tear on any asset. We're using delivery truck, but it could be really any asset. The wear and tear on that asset decreases the value of that asset. And to look at the real value of our assets on particularly our balance sheet, as we'll see later on, uh, means to us that we need to look at them realistically. We need to look at the fact that some of them decrease in value, some may actually increase in value. For example, if we have property and it's a good location, it may very well increase in value. So that's the opposite. But most of the time, an asset, whether it's a delivery truck, a computer, a desk, a chair, whatever it might be, eventually wears out and declines in value. So we need to take a look at that realistically. So after 5 or 6 years, looking at delivery truck in your ledger and saying it's worth 50,000 is unrealistic. So as the accountant, now you're going to have to deal with handling that fact of life. Let's look now at how this delivery truck asset account would be handled. One simple method of depreciation is called straight line depreciation. Straight line depreciation. There are a number of different kinds, but this is the simplest and the one that we'll be using. Let's say that the value of that truck has a useful life of 10 years, and there are ways of figuring this out. At the very beginning of the course, you remember something called Generally Accepted Accounting Principles, GAAP. Generally Accepted Accounting Principles. We use that in a number of ways. This is one way to determine what is likely to be the useful life of any asset. In this case, let's just, for argument's sake, assume that this truck has a useful life of 10 years. If we use the straight line method of depreciation for the truck, we will take the original cost of the truck, 50,000, and divide it by its useful life, 10 years, and determine the annual depreciation. In other words, how much does it decline in value each year? In our example, this means we'll have an annual depreciation of $5,000. So you simply take $50,000, divide it by 10. It's going to last 10 years. We lose 5,000 every year. At the end of 10 years, it's worth nothing. That's how we're going to be using this example. There's something called salvage value and trade-in value that we'll talk about just a little bit later, but let's hold off on that for right now. Let's just assume that at the end of 10 years, our delivery truck has been used so hard by our drivers that it's completely worn out and is worth nothing. So we need to show that depreciation over the course of 10 years. Divide the cost by 10 is $5,000 a year. Now here's the pertinent entry to this. Let's assume now we're at the end of the year. We're now on December 31, 2017, and we need to record this depreciation we just talked about into the books of the business. It's done like this. We have a date, and we have an account debited and account credited. So we decided that we are going to depreciate this truck by $5,000 a year, as we just talked about. The account that's debited is an expense account. It's called depreciation expense. And this is a bit different because most of the time when you have an expense, you end up debiting the expense and crediting cash. This time we will not be doing that. So you will debit by the 5,000 and we will credit what we call a contra account that we talked about just a moment ago, called, I'll abbreviate, accumulated depreciation, whoops, on the delivery truck, okay, $5,000. This is the entry. This is the depreciation entry. And our explanation is simply that. If I could spell it would help, huh? Depreciation on the truck. Okay, and now we need to post it. We go to depreciation expense in our ledger, and we find it here. This is 12/31/17, and that expense is debited, $5,000. We didn't have a journal number. I don't think we had a journal page in our journal, so we won't be able to do that. But the expense is 504 back in the journal, 504. And the accumulated depreciation is the contra account. And that's actually in the asset section. You see it's 103.5. The accumulated depreciation, 12/31/17. And that is credited by 5,000. And then the number, the accounts put back in the journal. So that is your entry, if I put my number correctly there. We debit depreciation expense by 5,000. We credit something called accumulated depreciation of the delivery truck for 5,000. And then we will do that each year. This is an annual depreciation entry that is made each year. So that when we go back to the asset account, the delivery truck account still says 50,000. That's the original cost. We're going to keep that there. But the accumulated depreciation is shown in the account right below it of 5,000. Next year we'll have another 5,000, another 5,000, another 5,000, and eventually you'll see that these credits will add up to 50,000, and then we have completely depreciated the delivery truck. Eventually, this all is shown on the balance sheet, and way down at the bottom I put a balance sheet here to show you how this is going to look. And I'm showing you only part of it, but this is the Ace Delivery Service balance sheet. We've got cash there, accounts receivable. I put a couple in there, but the main two are these two right here. The delivery truck is shown as 50,000, so we can always see what we paid for it, and the accumulation after the first year is 5,000. Now that account does not lose its balance. It continues to increase 5,000. So at the end of next year, we'll still have delivery truck for 50,000, and we'll have the accumulated depreciation now for the second year, another 5,000, so it'll be 10,000. So you can quickly see, if you know what you're looking at on a balance sheet, that the company bought a delivery truck for 50,000, and now it is worth less than that. In this case, on this date, December 31, 2017, it is worth 45,000, and we can see that on the balance sheet. So that's the essence of this chapter. We'll be talking about a little bit more in detail about that tomorrow. I'll give you some problems with that. But at this time, you have no further questions with this particular assignment, but I do want you to go through it maybe once or twice more to make sure that you understand the depreciation entry and how that is handled by the company. At this time, you can go back to your course page.